Hello and welcome everybody. Today we are here to talk to Apolline Blandin of the Cambridge Judge Business School Centre for Alternative Finance, and we're here to discuss the recent report that Apolline worked on titled the Third Global Crypto Asset Benchmarking Study. If I may ask Apolline to give a brief introduction, please.
Thank you a lot, Ian. So I'm Apolline. I lead the crypto asset research program at the CCAF. And so the core of our research is really to publish this annual benchmarking study on the crypto asset ecosystem. But we do have a lot of other side research projects. So we have one on Bitcoin mining in particular, and we also regularly publish a few reports on the legal and regulatory aspects of crypto assets.
Thank you, Apolline, and I'll introduce myself. My name is Ian Taylor. I'm the chair of CryptoUK. We're the UK's trade body representing the crypto industry and looking to build a bridge between the private sector and policy and lawmakers in the UK. Thank you for that intro, Apolline. The way that we're going to structure this session today is Apolline will give a presentation as to the major findings of the recent report, and then I'll ask a handful of questions after that, specifically focusing on the UK and the regulatory regime that is coming. I should also mention that we will also be talking to one of Apolline's colleagues from Cambridge Business School in a week's time with regards to another great report that they recently released, which is called the Legal and Regulatory Considerations for Digital Assets Report. Okay, so if I may hand over to you now, Apolline. Thank you.
Thanks a lot. Can you all see my screen?
Yes.
Okay, all good. So we published this crypto asset, the third edition of the crypto asset benchmarking study earlier this year, so at the end of September. And like any good academics, I should start with a short overview of the methodology we use for that benchmarking study. So every year when we conduct that study, we have two surveys. So one directed at crypto asset service providers like exchanges, payment service providers, and custody service providers, and another survey for actors within the mining industry. And this year we had a total of 280 responses, which is a 56% increase compared to the study sample of 2018, which is quite a small success for us. And I think part of the reason for that is that we had the service translated in 8 languages. So that really helped us distribute the survey in areas we had difficulty covering in the previous years. And also we always partner with local industry associations, but also crypto native outlets and other media to help us distribute the surveys to a maximum of actors. So just to give you a quick idea of the geographic distribution of the study sample. So on the left, the pie chart is the geographic breakdown for respondents to the service provider survey. So as we see, the sample is mainly dominated by European service providers, followed by Asia and Pacific. And it's slightly reversed when we look at the mining sample, with a majority of respondents coming from Asia Pacific, followed by Europe and in North America. I think one point to note here is like we've been able to increase the representation of companies in Latin America and Middle East to a certain extent, which I think is really important to make sure that the sample we work with are representative of the industry. Let's now move on to the first section of the report discuss these growth indicators, which kind of help us understand the dynamics and provide some business statistics about the industry. And we'll also compare it to other industry in Europe primarily. So over the years, we've collected information and data points about the FT, so full-time employee figures of service providers, but also mining actors. And I think the first important trend, which will probably come as no surprise to most of the listeners, is that the massive growth in employment that we observed first between 2017 and 2018 massively decreased between 2018 and 2019. And so the data point is that across all market segments, respondents reported a year-on-year employment growth of 21%. in 2019 compared to 57% in 2018. Again, that will come as no surprise because we went through this so-called crypto winter. But I guess what is interesting is that there is a difference if you compare what we call the industry level or the industry aggregate and the growth at the firm level. And the difference between those two is actually revealing that there are some large firms dominating the sample and dominating at the industry level. And that's why we see such a difference between the industry aggregate and the firm level data point. Another interesting trend is that regions have been unevenly impacted by the slowdown. So at the industry level, we see that Europe and North America have been the least impacted. But that's also, again, different story at the firm level because, again, there are large companies dominating in these regions. We also use that FT data point to look at what we call high growth companies. So a high growth company is another type of growth indicator used in business statistics. And we just use a standard definition provided by the OECD and Eurostat, which essentially defines a high growth company as a firm growing over 10% its workforce over 3 years and starting with at least 10 employees at the beginning of the growth period. And what's interesting is that for the crypto asset industry, about 1 in 4 companies qualify as a high growth firm, which is quite high when compared to other industries. So we have a comparison here with the data provided by the European Commission that found that in 2017, high growth firms represented 17% of European companies in the information and communication sector. And this high growth firm phenomenon is primarily visible in Asia Pacific, where 39% of firms there qualify as a high growth company. And obviously, these high growth firms are also a driver of employment within the industry. And so what we found is that 2 in 3 employees are hired by a high growth firm in between 2017 and 2019. So that was a quick overview for the growth indicators of the crypto asset industry. And now I'll move on to crypto asset usage. But before I do this, I think it's important for listeners to understand that these sections deal with what we call off-chain data. So I think most people will be familiar with analysis piece by Chainalysis or Elliptic that are actually using data points or on-chain data. Whereas all the data I'm going to present here come from service providers and payment or exchanges. And so these are all information that are not transactions that are not certainly on-chain. And so data that we can only collect from service providers. And what's interesting with this off-chain data is that it really provides a complementary story to the one provided by analysis by Chainalysis, for instance. And the first thing we look at is the type of coins being supported by service providers. Again, unsurprisingly, this year Bitcoin is vastly dominating because of its high convertibility into other crypto assets and other sovereign fiat currencies. A notable trend for this year was the vast increase in support to Tether and other stable coins. So that kind of echo another data point or another figure we had from other data providers like Coinmetrics that show that the volume of the amount of transaction being transacted on stablecoin has overtaken, I think, Bitcoin. It was in June this year for the first time. So that's definitely one thing. And here we see, for instance, that the support for Tether grew from 4% in 2018 to 32% this year. So that's significant. And another point we were actually a bit surprised to see is that the support for privacy coins like Zcash and Monero keeps increasing despite greater scrutiny from regulatory authorities over the use of this type of privacy coin. Moving on to the way users interact with the crypto asset ecosystem. So exchanges are one of the main components of this off-chain story. And here, what you see on the bottom right is the internal currency mix at exchanges. And so what we see is that the vast majority of transactions happening at the exchanges are between crypto asset and fiat and vice versa. And so that really tells you that exchanges are primarily being used as fiat on off-ramp, and that crypto asset users primarily use it to enter and leave the crypto asset ecosystem. What is interesting, however, is that if you look at Asia Pacific, so exchanges based in Asia Pacific record a much larger share of crypto asset to crypto asset trade, so about 41% compared to 19% in Europe or 14% in North America. And one possible explanation we give for that is that users might be onboarded via a European exchange, but then migrate to an Asian exchange. And there might be several explanations for that. The first one is that the vast majority of Asian exchanges have an order book compared to exchanges that are just brokers in other regions. They also tend to support a much wider range of coins. So I think it's about 40 compared to like 13 on average for European exchange. And they probably notoriously known for offering a greater leverage. So here on the bottom left, I put some figures about the leverage multiple offered by Asian exchanges. So the median is about 50 times, but we know that some exchanges offer about 110, 111 leverage to users. So that might be quite attractive for certain users as well. And this is actually confirmed when looking at this chart. So this chart is what we call a Sankey chart. So essentially what you're seeing is the flow of transaction and where is the transaction initiated heading towards. So on the right side, you have the transaction destination. So open markets is the equivalent of order book. Internal account is an internal account at the exchange, and external wallet is transactions that are settling on chain. And so if you look here, what is also quite significant is that a transaction initiated at Asian exchanges, for the vast majority, go to their open market. So that means that a very little amount of volume actually leave Asian exchanges. So it means that they concentrate a lot of activity on their own order book. And that's also a trend we observe when comparing the size of exchanges. So large exchanges tend to have a higher average of transaction on their open markets compared to small exchanges. So it's 70% compared to 42%. And that kind of follows the breakdown of exchanges across regions as well. Moving on now to the geographic distribution of crypto asset users. So maybe before that, I put this updated figure that we calculated of the number of unique crypto asset users, which we estimate at about 101 million, compared to, I think it was 36 million back in 2018. I'm sure we'll have the chance to discuss this a bit further during the Q&A, so I'll leave it and keep the explanation for later. But so yeah, that's the updated figure, about 100 million unique crypto asset users. And we then ask service providers about the geographic breakdown of their customer base. And again, this year follows a similar trend to what we saw in 2018, which is that firms primarily serve customers in their region. And this is less true probably for companies in North America and in Middle East and Africa. We suppose that this is because North American firms have had a very aggressive internationalization strategy compared to other regions. But yeah, the general trend remains that firms primarily serve customers from their region. Another very hotly debated topic in the crypto asset industry, I mean, recently, but also a couple of years ago, is whether institutional investors are coming. And there's been a lot of research being done around it. And I think I really liked a recent report by Fidelity that kind of showed that the majority of institutional investors they surveyed in Europe and in the US consider investing in crypto assets. And what's interesting is that when we compare to the data point we have, our data shows that the customer base is primarily retail driven. But here, I should emphasize that we're not weighting these figures by volume. So it might be that there is much more volume being generated by institutional investors. Nevertheless, it's interesting to see that retail users still make up the majority of the customer base of these service providers across region. But maybe so North America and European firms tends to have a larger share of institutional investors and business clients. So about on average 30%. And these type of institutional clients can be crypto-asset hedge funds, but also more traditional institutional investors like asset manager or family offices. I'll now move on to the regulatory and compliance section. So that's a section we have every year, and so we survey companies about the amount of resources they allocate to compliance. And so here, this map kind of shows you what is the median cost and the median headcount of compliance at service providers. And so what's interesting is that the median is about 8% everywhere except in Europe, and that actually half of European service providers report the compliance headcounts and costs equal or greater to 13%, and that compares to 8% back in 2018. And the reason might be, just because there's been a lot more regulatory development in Europe, which kind of put more pressure on firms to allocate more resources to compliance. What is interesting also is that North American firms, although they have a median headcount and median cost of 8%, when you look at the North American distribution, there is actually a huge variation across firms, across North American firms. And one possible explanation might be that some North American firms choose to operate across all US states, and so to comply with the patchwork of regulation, if you like, whereas other firms probably would avoid certain states with more stringent regulation and higher compliance costs. This year, what we did also for the first time in partnership with CryptoCompare was to look at the type of licenses and registration held by a service provider. And so we found that we actually collected the data manually, and so we found for 45% of surveyed companies we've been able to identify a license or a registration. So it doesn't mean that for the other 55% for which we haven't been able to identify a license, it doesn't mean that they are necessarily avoiding regulation. They might as well, be offering a service that is not yet being regulated or being operating in a jurisdiction where there is no regulation. But when focusing on the company for which we have identified a license or a registration, what is interesting is to see that the majority of these licensed firms are based in Europe, then North America, and then Asia Pacific. And nearly 1 in 2 of them actually hold what we call a crypto-specific license. So what we mean by crypto-specific is any licensing regime that has been introduced by a bespoke regulatory regime, like what you will see in Malta or Gibraltar. But also any regulation or legislation that has been retrofitted to oversight other crypto assets activities. So like what you have in Japan, where they amended their Payment Service Act to also regulate crypto asset exchange, and then have a licensing regime for crypto asset exchanges specifically. And so when they don't hold a crypto asset specific license, they might hold a payment or e-money institution license, being registered as money service businesses, or having a trading facility or broker-dealer license. What we found is that the median firm hold 1 license, but we found for some firm actually had as many as 5 licenses, which is quite significant. The next topic about regulatory and compliance relates to AML and KYC, and how firms comply with these requirements. So maybe before that, another observation we noted is that with the new and recent regulatory development, at least between 2018 and 2020, we saw that a lot of firms have started offering fiat. A lot of firms that didn't offer fiat currency now support both crypto and fiat currency. And that might just be a result of regulation, whereby requirements for holding exclusively crypto assets are not the same as holding both crypto assets and fiat. And so we noted that 30% of survey companies that exclusively supported crypto assets in 2018 now support fiat. So that's quite a lot, actually. And in the meantime, the company that only supports crypto assets, we saw a massive drop in the one that do not perform KYC. So it was about 48% of crypto asset only firms that did not perform KYC in 2018, and it's only 13% in 2020. Because of so you're probably familiar, or the listener will probably be familiar with the 12 months review report published by the Financial Action Task Force in June this year. And kind of following on this, we decided to have a focus on, companies incorporated in a jurisdiction that is part of the Financial Action Task Force versus a company that is incorporated in a non-FATF member. So that's what we call FATF and non-FATF. And there was a few distinctive points that we observed, which were interesting. The first one was that companies incorporated in a FATF member country tend to perform KYC checks much more frequently and on all accounts compared to non-FATF incorporated country. And we also it also suggests that KYC checks performed among companies that are incorporated in a FATF country are slightly more stringent, because about the median firm, the average would be that 8% of KYC checks among those firms lead to the closure of an account. That was a bit convoluted, but it's written here. Another interesting and important point is the audits of service providers' crypto asset reserves. Again, listeners might have heard about ways to perform on-chain audits of reserves held by service providers. So these are called proof of reserve or proof of solvency. So this is not yet widespread, but there's definitely a few discussion about it. But regardless, what is interesting to see is that the majority of firms have conducted an independent audit of their crypto asset reserve in the past 12 months. But there is a significant difference between the Asian versus the North American firm. The Asian, the North American, and the rest. So it's much more, Asian firms and North American service providers are more likely to have performed such an externally led audit compared to European or Latin American firms. And finally, which I think is a bit of an elephant in the room that everyone knows about, but there's not much conversation around it, is insurance. We asked this question for the first time, and what we found is that nearly half of service providers are not insured against any risk. And what's interesting is that there was very little distinction between a custodial versus a non-custodial service provider. And so here you have the breakdown by region, and so we see that it's more or less kind of homogeneous across region. But when firms are insured against certain risks, they are mostly protected against cybercrime, professional service errors, or loss or theft of private keys. I'll move on to section 5, which is about the mining industry. So in the report, we have an extensive first section about the mining industry, where we really provided deep dive. So we have this mining section every year, but I think this year we really wanted to put it first because we feel that the mining industry tends to be overlooked and not and kind of poorly understood sometimes. So we felt it was important to give it a special place, I would say. So this graph is just to remind people how with the different actors that constitute the mining industry. So you would have hardware manufacturers, hashers or miner if you prefer, pool operators, and then miners that also offer mining services or remote hosting services. And so we survey all of these type of actors. There is, as soon as you talk about proof of work mining, I guess the main comment you get is that it's contributing to global warming. And I mean, it might in some ways, but there is a lot of nuances to bring into this debate. And so that's why we launched the Cambridge Bitcoin Electricity Consumption Index last year, which is a live estimate of the amount of electricity consumed by the Bitcoin network. And what we try to do with the survey this year is to gather more data about the share of renewables being used by miners. And so what the figure shows here is that 76% of hashers use renewable energies as part of their energy mix. Obviously, that doesn't tell you how much. And so we also calculated and asked hashers how much of their energy comes from renewable. And so on average, it's about 39% of minings that comes from renewables. And when I say renewables, it's primarily hydroelectric and coal. And so that the current graph kind of shows the geographic breakdown and where what are the most popular energy sources across region. And so unsurprisingly, Asia Pacific has a lot of hydroelectric energy, so primarily coming from region like Sichuan in China, but also a lot of coal. And that is because you have very coal intensive area like Inner Mongolia or Xinjiang, but as well as Kazakhstan. I think what is interesting here as well is North America, that has a much mixed energy source. And the reason is that a lot of North American miners are actually connecting to the grid. And so they naturally have access to a mix of energy sources. The other point I wanted to bring about mining, because I think it's one that is being debated a lot within the mining industry, but not as much outside of the mining industry, is hedging strategies employed by hashers to hedge their risks. So there's been a lot of discussion recently about the use of new financial products like hash rate futures or difficulty forwards. But actually, these type of sophisticated financial products are still very much in their infancy, and we don't see a lot of hashers using this type of hedging strategies. Rather, they tend to use much more basic strategy like holding cryptoasset reserves or holding fiat national currency in reserve. Only a few minority and primarily North American one actually experiment with other type of financial products like cryptoasset derivatives or hash rate derivatives. And I'll just finish with one slide, which is, so we have a few sentiment questions in our survey. And so we show a lot of them in the report, but there I just selected the one about the perspective of service providers on various topics that might have a significant impact in the next 12 months. And so here it's all ranked according to Europe. And so what you can see here is that European firms are primarily concerned with stablecoins or are seeing stablecoin as a major development for the next 12 months. Followed by staking and decentralized finance. Actually, if you look at all the region, stablecoin really come among the top ones, followed by staking and decentralized finance. Maybe perhaps a bit surprisingly is that CBDCs are ranking quite low, in particular in Europe, but that might just be because we asked actually the questions before a lot of the recent announcements that were made by the European Central Bank, etc. So that figure might actually change if we were to ask the question again now. All right, I'll probably leave it here. I hope it wasn't too long, and happy to answer any question.
Thank you very much, Apolline. That was a very informative and insightful presentation. And before we dive into the questions for you, I think it's been a long time coming, having some real respected quantitative data for our industry. I talk to folks at Her Majesty's Treasury on a regular basis, and these are the questions that always get asked to me. Well, can you provide some information? Can you provide some data? What are the numbers? And so that's fantastic that you've refreshed this report, that you've had 2 previous iterations, that brings it up to date. So if I can start with a more generic question for you, please. I noted from the report that the exchanges based out of APAC record the highest share of cryptoasset trades, so some 40% versus the rest of the world. And then overlaying that with the information in the regulatory section, it seems that over 2/3 of the surveyed firms are licensed or in the process of obtaining a license. And these firms, with the majority of firms that are within a regulatory perimeter, are based in Europe. Now, specifically in regards to KYC, which you touched on there, the report shows that nearly all customer accounts at European and North American service providers have been KYC'd, whereas this doesn't appear to be the case for the other market participants out of Asia and the Middle East. Can you sort of touch on that correlation that we noted?
Yeah, I'm actually, I don't know if I put the figure about the geographic distribution of KYC, but yeah, so the trend that we see is that definitely firms that support both cryptos and fiats obviously perform a lot more KYC. As when it comes to Asian exchanges, again, there is, I don't have the exact figure in mind, but actually the share of Asian service provider that perform KYC was significantly high. But it's true that, why is there so much crypto to crypto volume happening on Asian exchanges? I mean, we highlight a few factors, like the fact that they have an order book, the fact that they support a larger range of coins, or that they offer greater leverage. But lower regulatory requirements is also probably one. So yeah, that's definitely something that could justify such a significant volume.
Mm-hmm. And I look forward to the next iteration to see how that particular spread has changed, because some of the members of the community that we speak to would, this is to your point around insurance protection, that safeguard that a regulated business or a particular activity would bring more consumer confidence, and thus you perhaps would see greater volumes in regions where there is this clarity. So yeah, this is obviously really changing right now, so we'll have to see how that plays out.
Absolutely.
All right, well, let me move on to the next question here, if I may. So in terms of the size and growth of the crypto market, from the specific perspective of using the employment data that you gave us an insight to at the beginning of your presentation, I note that there was explosive growth from 2017 to 2018, perhaps due to the ICO boom and some hype around new forms of raising capital, for example. But then this had somewhat reduced. There was still growth, but the growth numbers had reduced significantly from 2018 to 2019. And my experience is this year, because of this regulatory clarity we're seeing in 2020, especially in the West, with bringing the institutional investment, and I noted you mentioned the Fidelity report, which was great to see that about 30% of large fund managers in the United States are diversifying their portfolio and investing in crypto assets. So with this clarity comes institutional investment, as we know. Most of my information is qualitative. What's your view from the research you've done? Where will this sort of growth number be regarding employment and other metrics be for the next iteration of the report?
Yeah, and that's a really valid point. And actually, that's something we kind of realized while the survey was really already out, is that we should have probably further divide the survey between, retail versus institutional, because what you're really seeing at the moment is that certain service providers are exclusively serving institutional investors. And that is probably something that we don't capture well enough, I would say, in this current version. And so that's why, for instance, when I'm putting this figure about the breakdown of the customer base, we see, the customer base being primarily retail driven. The reason being that we really cover, all service providers, even in like a very small jurisdiction, even very, very small exchanges. So if we have a better sampling of service providers that exclusively serve institutional investors, I think we would see a different picture. And so I think that's something we'll definitely work on for next year, trying to have a more tailored survey for companies that exclusively serve institutional investors to better capture what is actually happening there.
No, for sure. Thank you, Apolline. And I'll move the next question on to mining, because it's a key feature of your report. And I liked the term that you used, calling it the backbone of the industry, which indeed it is. It bootstraps a network and provides the security that public blockchains need. I would also mention that you guys have a very, very excellent interactive Bitcoin mining map on your website. So please, folks, go and see that, and also the index, the mining index you touched on. So I recall that you mentioned some of the renewable energy sources, which is really interesting to see. And I suppose the industry comes under some great deal of fire for proof of work consensus mechanisms, obviously utilizing a heck of a lot of energy, and some people make comparisons between particular countries utilizing the same amount of energy as a Bitcoin blockchain, for example. So could you just sort of touch on where you see the trend moving from, renewables from traditional energy sources such as carbon-based products to renewable energy? Are you seeing an increase there in your data?
So yeah, that's definitely a very touchy point, but very fascinating, because you really have these two sides of the debate. Bitcoin defenders that argue that mining is driving the green revolution and that everything is being powered by renewable, versus those saying that Bitcoin mining contributes to global warming. And I think, it's really nuanced, and you also have to take into account local politics. So what we see with the mining map, what was really helpful is to try to understand what is the geographic distribution of Bitcoin mining. And so what we're seeing is that, again, the majority, unsurprisingly, comes from China, primarily Sichuan during the rainy season, then Xinjiang during the non-rainy season, I would say. But that you also have other regions where mining is taking up quite significantly, so like Russia, Kazakhstan, Iran, and North America. Unfortunately, North America and Canada is not well represented, I would say, in our Bitcoin mining map because of the type of pools we've collaborated with. But I think there is a slightly higher percentage of mining taking place in Canada compared to what we show on the mining map. But back to my point about the geographic distribution of mining. So these regions are then each kind of associated with a different type of energy source. So Sichuan is well known for its surplus of hydropower. And there's been some instances where local governments have actually called on miners to come and tap into these surplus of energy. But what we heard recently, for instance, is that the process of moving your machines from one region to another is probably not as profitable as it used to be. And so there will be less incentive for miners to actually go to Sichuan to get access to cheap electricity, and instead will stay in a region like Xinjiang or in Mongolia, which are mainly powered by coal. And the same reason also you would have a surplus of hydropower in Sichuan, which is because the Chinese government has invested a lot in hydropower infrastructure. The same reason is driving the government to invest in new coal power plant. And these power plants will also probably come with a certain surplus of energy. So you would expect also miners to move to these close to these coal mines to actually get access to cheap electricity. So I think it's constantly moving. There is a significant share of renewables, but it's, I mean, to me, 40% is already quite a lot. And I think, you know, this is going to move around that figures, I think, in the next few years.
Yeah, and we know in the industry that this isn't good, the amount of energy that's consumed for blockchains, but we do know that there's a lot of work going on in hardware development, also in terms of some big blockchains changing their consensus model to proof of stake, which is less labor intensive. So we are, as an industry, are working towards addressing this issue, which is great to see. Well, I'll move the next question to the sort of numbers of users that you talk about globally. And I noticed in 2018, in your second report, that you reported 35 million users across the globe. And then using the same methodology for the follow-up, this report in 2019, that had increased threefold, approximately, to 101 million unique users. Now, turning to the UK, we noted in the summer the FCA produced a report showing that users from 2018 to 2019 had increased from 1.6 to 2.5 million, so almost a 40 to 45% increase there. Again, similar trend to your global stats. You know, as I mentioned earlier, this year we're seeing a lot of the regulatory clarity, which is piquing the interest of the institutional space, especially in the sort of trading and financial side of the industry. Could you talk a little bit about what you're seeing in terms of the split between retail and institutional investors?
Yeah, just before that, if you allow me, I just want to give a bit of explanation about this figure, because I think it's a very, you know, media tend to pick up that figures quite a lot, and it deserves a bit of explanation because it should be taken with a pinch of salt. Because the methodology, I mean, we completely, you know, explain it in the previous report and in this one. So essentially what we do is we calculate the ratio of identity verified users compared to the number of accounts held at service providers. And then we collect additional public data about other service providers that we haven't been able to survey. And then we apply that ratio that we got from the survey data to this aggregate figure of accounts that we obtained from other sources. And so the reason why we have such an increase between 2018 and 2020, I think, is twofold. The first reason is that there's probably been a few more CryptoAsset users joining the CryptoAsset ecosystem, but obviously, this doesn't take into account, you know, some non-active users. And the other reason is that because the share of accounts that are not being linked to user identity has increased, obviously we're being able to count, you know, more users. And so that being said, what it means is that the 35 million figures was probably too low back in 2018. So yeah, so that's why we're having such large figure this year, which I think is still reasonable. I mean, when you see certain exchanges having registering, you know, millions of new users every, I don't know, 6 months, it's quite impressive. And as for institutional investors versus retail users, so again, here we don't make the distinction when we ask this question about service to service providers. We don't make the distinction between retail versus institutional. The only time we ask them is like, what share of their customer come from you know, institutions, and that's the figure I was showing earlier, where again we see companies in Europe and in North America serving institutional investors much more frequently than firms in other regions.
Yeah, and I'll just add on to that. We've recently received the news that PayPal are going to allow their users to purchase goods and services using crypto assets and even buy crypto assets within their ecosystem. And we know PayPal has hundreds of millions of users, so one can only assume that would grow those numbers going forward when they release that offering. Okay, so let's move on to the fifth and final question. So you touched on regulation, and obviously a very big area, and that's a lot of the work we do at CryptoUK. We've seen, specifically in the UK this year, quite a lot of development, whether it be the KYC and AML licensing regime, or the banning of crypto derivatives for the retail sector. And a recent consultation just closed, a public consultation for promotions, specifically promoting crypto products in the UK, and then looking at Europe. Out of the European Commission, we saw so-called MiCA, markets in crypto assets. I know the report is looking at 2019, but from your view, Apolline, can you talk a little bit about whether you see any regulatory arbitrage when you speak to any of the market participants, and is that highlighted in any of the findings?
Yeah, so regulatory arbitrage, I mean, it's yeah, there are different ways to kind of point to it. And I think our approach has been twofold. So the first thing is just to look at, where is a company incorporated versus where is it operating from. And so this year what we found is that 22% of companies have been incorporated in a different region compared to their operational headquarters. And that's when they are, those who are incorporated in another jurisdiction are usually incorporated in Switzerland, in the UK, in BVI, or Republic of Seychelles. The other form of regulatory arbitrage is obviously when it comes to the licenses. And so that's a little bit more complicated to assess, but you definitely see that certain firms are looking for regulatory certainty, and so regardless, I mean they would tend to go to a jurisdiction where there is a bespoke regulatory regime and where they have very explicit requirements. And so I think the point you noted earlier that we are having greater regulatory clarity across jurisdiction will help to probably reduce that regulatory arbitrage and seeing a lot of firms actually stay in their jurisdiction of operation, because they will get regulatory stability from there instead of having to find another more kind of explicit regime in another jurisdiction.
Yeah, and that's exactly what the MiCA regulation will do for the whole Eurozone, bring clarity across the piece because it's binding on all the member nations. Great. Well, I think from our side that's it with the questions. So again, a big thank you for your time, Apolline.
Thanks for having me. That was fun.
We love the great work you do, and long may it continue. And if anybody wants to reach out to you and your colleagues, how do they go about doing so?
You can contact me on Twitter at Apolline Blandin. Otherwise, I'm not going to give you the CCAF URL because it's very long, but if you just Google CCAF, you should see us coming up first or second. Yeah, and it would be really great because we're going to conduct another version of that survey. So having CryptoUK members also participating, and any listener interested in the research is very welcome.
I would urge any of our listeners to dive into this report. It's very thorough. It's over 70 pages and exactly what we need as an industry to start moving forward. All right. Well, thank you very much and goodbye.
Thank you very much, Ian.